If you read the financial headlines today, you'd probably think the traditional office building was completely dead. I mean, just a total relic of 2019, right?
Oh, absolutely. That's the prevailing narrative.
Right. The story is that downtowns are empty, companies are slashing their real estate footprint, and, commercial property is just this toxic asset. But if you look at where the smartest money in the world is actually moving right now.
A completely different reality emerges.
Exactly. Billions of dollars are quietly pouring into physical office spaces and, well, massive industrial hubs. So, welcome to the deep dive. Today, we're looking at a massive stack of Q1 2026 financial reports and earnings presentations from JLL.
That's Jones Lang LaSalle for those keeping track.
Right, one of the largest commercial real estate and investment management firms on the planet. And for you listening, whether you're an investor, maybe someone mapping out global supply chains, or just an employee wondering why your company is suddenly mandating 3 days a week in a brand new building, this deep dive is for you. JLL's balance sheet is really the ultimate insider's roadmap to how the post-pandemic economy is actually functioning.
Yeah, it's literally the physical machinery of the economy at work. I mean,
Yeah.
we often get caught up in these abstract indicators, right? Like GDP growth curves or inflation
Do
report.
theoretical stuff.
Exactly. But commercial real estate shows you exactly where corporations are putting the actual desks and where they're storing their physical goods. And this specific first quarter from JLL is just incredibly telling.
Yeah, it really is.
What looks like a simple slide deck of financial data is, well, it's actually a real-time tracking system of shifting global human behavior.
And the numbers are just staggering. I mean, we are talking about a record-breaking first quarter for JLL. They saw a 207% jump in diluted earnings per share, hitting $3.33.
Which is a massive leap.
It's huge. And they specifically note that this is in local currency, which that basically strips out the noise of exchange rate fluctuations and just shows pure operational momentum.
Okay, let's unpack this, because you don't hit a 207% jump in earnings purely by accident, especially when the macroeconomic narrative is, so full of anxiety.
You certainly don't. To really understand how JLL pulled off those earnings, and that included over $6 billion in Q1 revenue alone. By the way, we have to look at the broader capital markets.
Right, because JLI doesn't operate in a vacuum.
Exactly. They're an advisory and management engine for global capital. And the data in these reports shows that global investors have distinctly adopted a risk-on posture for deploying their capital.
Okay, so I hear risk-on used a lot on trading floors, and it usually means like the caution tape is coming down and the checkbooks are opening up. But I have to push back here a little bit. Sure, go ahead.
We are constantly reading about heightened geopolitical risks, supply chain fragility, inflation hangovers. How does a massive commercial real estate firm pull off a quarter like this when the world feels so unpredictable? Why is the checkbook opening right now?
Well, what's fascinating here is how the market is adapting to shifting risk-free rates. It's not that institutional investors are just, ignoring the geopolitical risks. It's that they finally priced them into their models.
So the uncertainty isn't paralyzing them anymore.
Exactly. The source material highlights this with a very specific metric. Global direct investment volume grew 11% year over year in local currency.
Wow.
Yeah. And if you look at it in US dollars, it's actually an 18% jump. So, I mean, the money is definitely moving again.
Where is it moving geographically? Like, is this a localized boom or is it happening everywhere?
It's heavily concentrated in specific regions. The Americas saw a massive 25% spike in investment volume.
A 25% spike.
Yeah, and the Asia-Pacific region saw a 20% jump, which the reports note was led heavily by strong activity in Japan and Singapore. Investors are really targeting jurisdictions where they see stable regulatory environments and clear economic momentum.
That makes sense. But the source material also mentions something a bit dense that I definitely want to translate for our listeners. It notes that asset pricing remains resilient, but there are, quote, select pockets of minimal yield expansion on lower quality transactions.
Right. That's a bit of a mouthful.
It is. I understand what a lower quality building is, obviously. But what does minimal yield expansion actually mean in plain English, and why does it matter?
Okay, that is a crucial piece of jargon to decode. In real estate, the yield is the income a building generates relative to its price.
Okay.
So if a building's price drops, the yield mathematically goes up or expands. So when JLL notes there's yield expansion on lower quality transactions, it basically means investors are demanding a steeper discount to buy mediocre buildings.
Oh, I see.
Yeah, they're essentially saying, I will only buy this outdated property if I get it at a bargain price that guarantees me a higher percentage return.
Ah, so investors aren't just blindly throwing money at any building with a door. They are being highly selective.
That is the core takeaway here. They have robust liquidity, they're seeing pricing stability, but the money is flowing with extreme precision.
Interesting.
The scrutiny is intense, right? They're willing to pay top dollars for the best assets, but they are heavily discounting everything else.
Which transitions perfectly into where that selective money is flowing by sector. Because when you look at JLL's data, it tells a tale of two entirely different physical worlds.
It really does.
I want to look at the office sector versus the industrial sector. Let's start with the office. We just talked about the prevailing narrative that the office is dead. Yet JLL is seeing outsized revenue growth in U.S. office leasing.
Yeah.
How is that even possible when global office leasing volumes actually dropped 1%?
Well, it is the ultimate paradox of the current economy. Global volumes dipped slightly, but North America completely bucked that trend, with leasing volumes up 7%.
Wait, really? Up 7%?
Up 7%. JLL attributes this to pent-up demand from lease renewals and higher overall office attendance. Companies that just kicked the can down the road on their real estate decisions for the last 3 years are finally being forced to make a move.
But wait, the reports also state that global office vacancy is sitting at 16.8%. That is a staggering amount of empty concrete.
It's massive.
So how is JLL making so much money on leasing advisory when the market is literally flooded with empty space?
Because of that exact intense selectivity we just discussed.
Yeah.
Yes, there is 16.8% vacancy globally, but the reports reveal a fierce supply shortage for high-quality space across the U.S. and Europe.
Oh, so they're abandoning the office, but they're only abandoning the mediocre offices.
Exactly. It's a massive flight to quality.
So to get humans back to desks, companies know they can't just offer, a sea of gray cubicles with flickering fluorescent lighting anymore. They need something much better.
If we connect this to the bigger picture, the office really has to earn the commute now.
Right.
Corporations are realizing they need premium, highly amenitized spaces. We're talking better locations, better air quality, better collaborative layouts.
And finding, negotiating, and building out those specific premium spaces is incredibly complex.
Extremely complex, and that complexity creates a highly lucrative advisory opportunity for JLL. So while overall global leasing volumes dipped, JLL's specific leasing advisory revenue jumped 16%.
Because they're the ones guiding these massive corporations through this intricate upgrade cycle. They're making larger commissions on more complex, high-value deals.
Exactly.
Okay, that makes total sense. So companies are upgrading to get humans back to desks, but humans are just one part of the economic equation. What about the physical goods these companies are selling? The JLL numbers on the industrial side paint a very different picture than the office market.
They do, and the industrial boom is fascinating because the drivers have fundamentally changed. JLL's numbers show solid gross leasing growth in North America and Europe. But this isn't about traditional warehousing anymore.
Right.
A major driver of this demand actually comes from 3PL's third-party logistics companies.
Let's define that for the listener real quick. A 3PL is a company you outsource your supply chain to, right? So if I start an e-commerce brand, I don't buy my own warehouse. I hire a 3PL to store my goods, pack the boxes, and ship them out.
Precisely. As businesses realize that supply chains are incredibly complex and, vulnerable to global shocks, they're increasingly outsourcing that headache to specialized 3PLs.
Which makes sense.
And those 3PLs need massive, highly efficient physical spaces to operate. E-commerce is still a huge driver of this, obviously, but the JLL reports specifically highlight another emerging powerhouse, which is advanced manufacturing.
I am so glad you brought that up because advanced manufacturing sounds like such a buzzword.
It does.
What does an advanced manufacturing footprint physically look like compared to, say, a standard warehouse from 1995?
Oh, the physical requirements are entirely different. A traditional warehouse just needed a roof, a loading dock, and maybe some pallet racks.
Right, pretty basic.
But advanced manufacturing spaces, they require reinforced flooring to handle heavy robotics, massive specialized power grids, advanced climate control, and, importantly, proximity to highly skilled labor pools.
Wow, so it's a completely different beast.
Completely. And JLL notes this trend is heavily driven by the regionalization of high-value manufacturing, meaning companies are bringing production closer to home to avoid supply chain disruption.
Ah, reshoring.
Exactly. That, alongside growing defense spending. Building and managing these specialized spaces is just a massive growth engine right now.
Here's where it gets really interesting, I think. We've established this intense physical demand for premium office spaces and these advanced industrial hubs. But JLL isn't just a broker making a flat commission on a lease signing.
No, not at all.
When you look at how they structure their revenue, it sounds like JLL is treating real estate less like a physical box and more like an operating system.
That is a brilliant analogy, actually. To understand how they monetize this demand, you have to look at their two strategic revenue buckets.
Okay.
First, they have advisory revenues, which are the more transactional pieces like leasing and capital markets. That segment was up 17%.
Which is great.
Yeah, but the second bucket is resilient revenues, which are recurring long-term contracts. That was up 7%. And the massive engine driving those resilient revenues is their Real Estate Management Services Division, or REMS.
And REMS generated just over $5 billion in revenue for the quarter.
It's incredible.
That is a colossal number just for managing properties. What are they actually doing to generate $5 billion?
The growth in REMS was heavily driven by two specific areas. First, project management, which was up 10%. As companies sign leases for these new premium spaces, JLL manages the complex, multi-million-dollar build-outs of the interiors.
Right, the actual construction and outfitting.
Exactly. But the second driver, and perhaps the most telling, is workplace management, which grew by 8% due to a wave of new client wins.
Workplace management. If the building is the iPhone, is JLL basically saying they provide the iOS? Like, what does an iOS for a concrete building actually look like for the people working inside it?
It looks like total integration. Managing a building is no longer just about making sure the HVAC runs and the security desk is staffed.
Right.
Workplace management is about optimizing the entire human experience inside the space. It involves tracking real-time space utilization, managing health and wellness protocols, monitoring carbon emissions, and just using software to make the physical building responsive.
Give me an example of that. What do you mean by responsive?
Well, imagine a building software realizing that only 30% of the fourth floor is occupied on a Friday. So it automatically scales down the lighting and cooling in the empty zones, saving the client thousands of dollars.
Oh, wow. That perfectly explains the structural shift JLL made this quarter. The reports note that effective January 1st, 2026, JLL moved their software and technology solutions, reporting to become a fifth business line directly under REMS. They took their standalone tech segment and basically baked it straight into their property management engine.
It really proves that you can no longer separate the software from the physical building. This structural realignment ties directly into what JLL CEO Christian Ulbrich emphasized regarding their Accelerate 2030 strategy.
Right, the data advantage.
Exactly. He specifically highlighted building an AI and data advantage. JLL is using massive global data sets to tell their clients not just what building to buy, but exactly how to run it to maximize employee productivity and financial returns.
And that tech-enabled, data-heavy approach seems to be a massive competitive advantage in their capital market services as well. The data shows that segment saw a 21% jump in local currency revenue, but the real standout was their equity advisory activity, which jumped nearly 80% compared to last year.
Which brings us back to the macro environment we discussed earlier.
Yes.
When institutional investors adopt a risk-on posture, they don't just write a check. They need highly complex debt and equity structuring to pull off these massive acquisitions.
And JLL provides that.
Yes. JLL's investment sales and debt advisory revenues significantly outpaced the broader market's growth this quarter. In a fluid, slightly unpredictable economic environment, clients flock to the advisor with the most data and the deepest market penetration. JLL is capturing market share simply by being the smartest underlying operating system.
So what does this all mean? When a company executes like this, generating $274 million in adjusted EBITDA, which is basically their cash profit from core operations, what do they actually do with the cash? Do they just stockpile it in a war chest?
Well, their corporate liquidity is incredibly strong, sitting at $3.39 billion.
Wow.
Yeah, and they manage a massive $86.9 billion in assets under management for their investment management wing. But if you want to know what management really thinks about the future, you have to look at their capital allocation.
Okay, what does that show?
The first quarter showed a very aggressive, confident strategy. They heavily bought back their own stock.
Yeah, the reports show $300 million repurchased in Q1 alone, and they specifically highlight a $200 million accelerated share repurchase program launched in March.
Right.
For our listeners who might not be deep in equity markets, what makes a share repurchase accelerated, and why is buying back 300 million of your own stocks such a big deal?
An accelerated share repurchase, or ASR, is this aggressive financial maneuver where a company buys a large block of its shares all at once from an investment bank, rather than slowly buying them on the open market over several months.
Oh, I see.
It is the ultimate bet on yourself. It signals to the market that the executive team believes their own stock is significantly undervalued and that they have supreme confidence in their future cash flows.
And they can only do that if their underlying debt isn't suffocating them, right? The report mentions their net leverage ratio dropped to 1.0x. In the world of commercial real estate, which is notoriously dependent on debt, what does having leverage that low actually allow them to do that their competitors cannot?
A 1.0x net leverage ratio means their total debt is equal to just 1 year of their earnings. In an industry built on borrowing, that is an incredibly pristine balance sheet.
That's a huge advantage.
It's a financial superpower. It means they aren't spending all their cash just servicing interest payments. This flexibility allows them to aggressively return capital to shareholders through buybacks while simultaneously investing in growth.
Like what kind of growth?
Well, for example, they also committed an incremental 100 million euros into the LaSalle Encore Plus fund.
Oh, okay.
They're putting their proprietary capital into the market because they fundamentally believe this risk-on rebound is a long-term trend, not just a momentary blip.
Which brings this entirely full circle for you listening today. Whether you're analyzing market signals, trying to understand why supply chains are shifting toward advanced manufacturing, or just, sitting in a newly renovated office wondering why the lighting is suddenly automated,
Right.
JLL's financial footprint acts as a decoder ring. It really is the physical manifestation of how the global economy is evolving.
It is. And as we synthesize all this data, this raises an important question, something for everyone to really mull over. We spent a lot of time discussing the intense supply shortage of premium, high-quality office space.
You did.
But we also acknowledge that overall global office vacancy is sitting at nearly 17%.
Right, the millions of square feet of older, unamenitized space that companies are just fleeing from.
Exactly. So what is the ultimate fate of those older, low-quality office buildings left behind in this flight to quality? As capital and tenants flow strictly to the premium tier, these older structures face a severe reckoning.
They really do.
Will they become the next great distressed asset crisis, potentially dragging down the regional banks that hold their mortgages? Or are we looking at an unprecedented canvas for urban reinvention? Could these obsolete office towers become the raw material for residential conversions, mixed-use community hubs, and basically the city planning miracles of the next decade?
That is the multi-trillion-dollar question right there. Because when you stop looking at the satellite image of the economy and you finally get down to the ground level, you realize someone is going to have to do something with all that empty concrete, and whoever figures out that puzzle first is going to write the next chapter of our cities.